Welcome to the future of money. Come with us on this journey into the world of Bitcoin, blockchain and crypto projects. You're going to meet the trailblazers. These people have changed my life and they may very well do the same for you. Welcome back everybody to our, not really a series, but there is in fact a playlist on DeFi. I think we've given you an overview of what DeFi is. In our last show we talked about how to set up a MetaMask wallet, use Uniswap to get into some of these projects. Welcome back, guys. Jordan, good to see you again. You've shown up naked this time. Nice.
What's up?
Twist on
hey,
things.
man, it's hot. It's on the beach, man. Sweat my balls off here.
Okay. Yep. I'm sure everyone's pleased to know that's happening. Stefano, welcome back from the most famous kitchen in all of YouTube.
Thank you.
The most famous kitchen in crypto.
Yeah, so obviously getting the admin out of the way. This isn't financial advice, people. We do hope we are educating you, however. Okay, so today we're going to have a very quick look at, once you've acquired some of these DeFi projects, how you can actually get an income off them. So on that note, Stefano, I'll throw it over to you to talk us through that process.
Sure. So you have two options of making a return once you buy a token. The easiest one, and the one that it's probably like majority of the people are doing right now, is just holding the token, nothing else. That's easier because you have that in your wallet, so security is on point. And second thing, because again, as we saw last time, you can swap pretty easily and fast. So if for whatever reason, for example, you buy into a token that, I don't know, in 24 hours gets a crazy return of 80% or 100%, and you're like, okay, I want to jump out, you just go on Uniswap once again, select the token, cash out, go back in ETH or whatever stable coin you want to enter, and that's it. The second option, which is what we saw last time, there was that, and we mentioned that we were not covering over there, but it was that liquidity pool fees. So, when you're in an exchange, you're paying fees, and those fees go straight to the exchange. Those are the revenue that goes on the company that runs the exchange. What Uniswap is very interesting for is that the liquidity comes from the users, and therefore the interaction with those smart contracts, when you're buying a token, the initial tokens that are in the smart contracts comes from the users. And so the fees, you're still paying fees in the same way that you would do that on an exchange. The only difference is that those fees are distributed among the user that are putting tokens into those smart contracts, which are called the liquidity pool. So what now is happening on the DeFi world is basically the fact that you can either store those tokens and so have them there and your return is only in change of prices, or you can take a much higher risk, just saying, it's a much higher risk first, but you're putting those tokens to work. And so, yes, you're still getting that return when the price change or not. And we're going to get into that in a moment. But you're also getting those fees that are coming from the people that are using the liquidity pool and therefore the smart contracts. Now, before we enter on showing anything and so on, why am I saying it might or it might not? When you're entering a liquidity pool, you are putting the same amount of tokens that you have purchased and ETH. So let's say, for example, that you're putting an equivalent amount of tokens that is equal to 0.1 ETH in value. You're putting those tokens into a smart contract, but you're also putting 0.1 ETH into that same liquidity pool and contract.
But the value is in USD, right? That's a super confusing thing for some people, right?
Yeah, that's
so
right.
You have to do, if ETH at the current time is 250 USD, you have to put an equal value of that token, $250 value. If those are only 1 cent each, you need 250,000 of them, right? quick math, bad math,
sure.
but it has to be equal value $250 USD.
Yes.
So that's where it gets a bit confusing.
And
but Uniswap will tell
I'm
you.
confused already, so I hope we're going to go through a practical example here.
Sure. Well,
STA.
Let's do that with the 495 STA that we bought last time. So let me start sharing my screen for a second. Brave browser once again. Share that. There it is. We're back on like our Uniswap thing. Let's just like refresh that in case. So last time we bought 500 STA, and because like of the logic of the token, we end up with 495. So we have 495 STA, and we still have like the remaining of that 1 ETH that we put into the wallet at the beginning. So how do you enter a liquidity pool? Pretty simple. You have swap here, which is like what we did last time, and here you have pool. You click on pool, and you have add liquidity. You click on add liquidity. Now it's not gonna show me that. Okay, so we're doing that like in another way because of like, obviously you can do that with the famous tokens as per usual.
We picked a micro cap, didn't we? So
yes, but there is still like a way of doing that, which is like still pretty simple. So we're just gonna like jump first, instead of like going on CoinGecko as we did like last time. This time we're gonna use the Uniswap info website. So the URL, as per usual, gonna be in the description. It's uniswap.info/home. Pretty straightforward. And what it does is basically showing you at the moment all the liquidity that is being provided on all the pools available. So you see all the pairs. Huh?
Totally mooning.
At the moment, graph. Yes, the graphs are like pretty self-explanatory, I would say. But you got like all the different pairs over here. Now, obviously, you can either like start changing page and like find what you're looking for, or you can actually search for a pair. So last time we have done STA. So in this specific case, we actually can find that because it's STA ETH pair. So we click over there, and this is showing you the graph of the liquidity pool at the moment. As you can see, it's skyrocketed in the past 2 days, and like it's going down today a little bit. Now up here, now there is obviously like the video, but let me just like move that so it's a little bit easier. You see that there is add liquidity. So on the top right, you click on add liquidity, and there it is. We're back on like our STA thing as we were before. So now we're ready to add liquidity into a pool. What we want to do, like just like for the example, we put like a max amount of STA. And it's also telling us how much ETH we need to put. So this is like a one important difference. Last time we took our ETH and we swapped them for something else. So the ETH went away and we gain a new token, the same way that it happens like on every single exchange.
We bought another project basically.
Yes, correct.
Could be BTC, whatever. It's just that we are.
Correct. In this specific case, if we want to finance a pool, a smart contract with a specific amount of tokens, we need also to put the same amount of value in ETH. So technically, we're adding two things into the pool. So for whatever reason, let's say that you have an ETH, you buy 1 ETH of a specific token, you will not be able to add liquidity into a pool because you need another ETH worth of ETH, just an ETH.
I think I'm starting to understand this. So in other words, we're effective. It's almost like traditional banking here. You're adding that liquidity that then can be lent out, hence the interest that we're going to earn.
Correct.
Well,
correct.
You're buying both sides of the order book.
Right.
Yes.
Right. Equal parts.
Correct.
Okay, so it's like buying a share in the bank, and then depositing your money in the bank.
Pretty much. Yep. Pretty much, yes.
And both assets.
Right. Okay.
So here is telling you like pretty much like how much of the pool we're going to own after this trade, which is 0.01%. So again, it's just like for educational purpose, nothing else. And once we have selected everything, we just click on approve STA. Now, what you are not seeing, for the same reason as last time, because it's like for security reason, we're having like a pop-up from the wallet that is telling us to allow Uniswap to spend our token. So with this approval, we're giving access to Uniswap to take the tokens out of our wallet and put that into a liquidity pool. Now, when you're doing that transaction, you are spending, as per usual, no surprise over there, gas fees. And so you put like your transaction, you're paying. So remember, you always need to have like some extra ETH to pay like all of these like transactions and stuff like that and so on. Now, I've confirmed the transaction. Obviously, like
a gas fee for the uninitiated is almost like going to an ATM and it's charging you a percentage to withdraw your money, right?
Yes, it is. It is from that
Cost
side.
of doing business, baby.
Yeah,
pretty much. Now, as you can see here, it says like approving STA because like the transaction is like start. Obviously, I need to kind of like speed up that as we done like last time. So just like to simplify things. I'm gonna spend $1.16, so just like so that people have an idea of like how much the gas fees it is right now. And at this point, we're just waiting. We need to have the Uniswap access in place in order to then like join the pool. So there it is. Transaction is being confirmed. As you can see, like up here, close that, and now we're ready to start on that. We click on supply. So we're doing exactly like what we were supposed to do at the beginning. That's just like the first step.
Mm-hmm.
We do
I don't
supply.
think that was clear yet. Hey, so the first step is you have to approve the contract.
Yes.
That it'll interact before you're
Correct.
actually supplying it, right? So there's two steps.
Yes. And so here is telling you like basically that you're putting in, as you can see, you will receive. So first of all, you will receive a synthetic token out of that. So in this specific case, we're gonna like receive 3.66168 of like this pair one that is gonna be like a different ERC20 token. This is the token that is gonna receive the fees. Then it's gonna tell you like how many STA we're depositing. See, it's also like already changed, by the way. The ETH that we're depositing, the rates between the two, and what is going to be like the final share in the pool that we're going to have. So we confirm the supply. It's going to ask us, as per usual, no change, confirmation on the wallet. Every single time that you're doing something is going to ask you to confirm the transaction. Now, in this specific case, on fast, so to speed up things, we're going to spend $4.51, just like to kind of like explain to everybody. Again, like dollars here, dollar there, we already spent like $10 most likely in all these transactions. So if you're thinking about like entering with like $50 to try, maybe don't do this.
Okay, so the fees are not a percentage; they're a fixed fee.
They're specific. No. It depends like on the gas fees of the network. It's not defined.
So if you're putting $50 in as opposed to $1 million, how does that influence the fee?
They're pretty much going to be almost the same.
Wow. Okay. So playing on small amounts in this scenario is not a good idea.
Not really. So here you see that there is like the confirmation. So the transaction has been done, and the pop-up was up here, now it disappeared, but it basically like told us that the transaction has been had as well, and we can see that on our position. Then we had our share in the pool. So now we have done this. There are pros and cons. The pro side is that we're making that return. So
sorry. What's the 3 points?
It's a synthetic token.
Right.
So what is happening is that like because we put STA and ETH inside that pool, the pool is giving back us to a new ERC20 token. Right. Now the fee, how are the fee being paid? the fee, let's say that like the pool is generating like $100 in fees in a day, and there are 100 people. So every single individual should have $1. Let's assume that they have like all of them put the same amount of money and they're equal shares. And so they all should receive $1 each. How does the pool knows to who they need to send that? They check that synthetic token, like this one, in this specific case, 3.621, which is the equivalent of like shares in a company where they're issuing dividends. Let's think about that in that way. They have an X amount of money to send, and they calculate that based on the percentage of the company and the shares or whatever thing you own. Yes. So what we're going to receive is the increase of this specific synthetic token. So they're going to pay us with this token on that side.
Right.
Now, the good part, and so the reason why so many people are doing that is exactly this. Now, instead of having that 495 STA sitting on my wallet doing nothing, now I have the 495 STA plus a 0.09185517. So let's just like assume a 0.1 ETH that are put in use and are starting generating money, which is a good thing. And so a lot of people would be like, this is super cool. I want to do that. Now, enormous alert, warning, careful, dangerous situation. Last time, what we have say, and what Jonathan has mentioned as well, is that when you are using Uniswap, there is no price point. You buy, you swap, you enter a position, the swap happens at whatever price is available based on the average of the price. So now I have my 490 STA that are in the pool, and anybody can buy them. So if the price increase and there is FOMO, for example, that's a good thing because I'm making a good return. But if the price collapses down for whatever reason and people start like buying that because it's very low, I'm actually going to end up losing money. So just
the thing is, yeah, like it's called impermanent loss. So if you buy a token and you pool it when it's at the bottom, and the one token, say your STA goes up and ETH stays stable, you lose your STA tokens, but you gain more ETH, right? So if you want to hold your STA, you're going to have less STA. Your dollar value will go up, but you're going to have less STA, right?
You're going to need to back up and run that by me one more time.
It's super complicated. We can put some links in. There's some articles written that explain it way better than I can. But basically the point is, if you're going to do liquidity pool, you want to do it when the token is at a higher value. If you put it in at the bottom and the token goes up, then you're going to lose the tokens that you want to hold.
So basically,
it's a little bit complicated because you're talking about two different tokens pegged to $1, right?
Let me try to explain that in a little bit. So if the main point of you buying into a DeFi project is because you expect an appreciation in the price, and so the price moving from 1 to 100, for example, you do not want to enter a liquidity pool. Because once you put your token into a liquidity pool, anybody can buy that. And so, for example, let's say that you're looking at that like from 1 to 100, the price goes to 10. So you still have that 90 to go through, but someone arrived and is like, oh, I like it, mine. You will gain the 10x, obviously, because it goes like into ETH at that point. But you don't have that token anymore. At that point, it's gone. On the other side, because you're actually putting in liquidity in two things, because you're putting both the token and the ETH, you need to be careful on the movements of both tokens at the same time. So a good situation for you is that the ratio between the two tokens stays as similar as possible on the moment where you enter. Because otherwise you might end up having a loss on one side or another.
Yeah,
you're
the
making
ideal
your fees.
situation is that both tokens move at the same time,
yes,
in the same direction.
Yes,
right?
Correct.
But because you're dealing with ETH, which is a volatile asset, and you're dealing with STA, which is a volatile asset, you're getting this equation of, up and down, and it doesn't match. So you get this impermanent loss. But the impermanent loss is cured just with time, because it does try to balance out, right? So if you ride the bull run up and it's like, oh, I've got almost no STA left, right? But then if you ride it all the way through down to the bear market of that token, then you gain your STA back.
Yes.
Right. So it depends on when you pull your liquidity out.
That's
right?
true.
So
That's
a
right.
simpler equation and an easier way to get into it is if you're using a stable coin, DAI, because DAI, it's pegged to $1. It's always $1. So you only have to worry about the value change of ETH.
Yes.
Right?
Yes.
So it's much easier to visualize liquidity pools and the impermanent loss, thinking about a stable coin as one pair and then ETH as the other pair, because there's only one variable there. That's the value of ETH, right?
Yes.
So, but when you've got two, it's like it's almost like a built-in short. If you pool your tokens at the top and it dumps, you're going to get way more of those tokens without having to trade it. If you put it in at the bottom, you're going to get way more ETH because it's going to get more ETH at the top.
It's basically like pulling what in finance is the butterfly model, where you're trying to protect yourself on either way, and the system is gonna self rebalancing itself based on the change of value. The point of that is that self rebalancing might not be what you are thinking about or what you are interested in.
How are you guys currently investing in these projects? Are you buying the token and providing liquidity, or what are you doing at the moment? Obviously, I'm new to this, so I'm just trying to wrap my head around.
So to me is because of the returns that are currently happening on and the movements that are happening on some of the tokens, I'm not into liquidity pools. I'm not providing any funds on liquidity pools because yes, you make your return. You can even make a 0.5, 0.7% return a day on your amount of money. But there are two factors on that. One, you still have the gas fees. So if you have a small percentage, the return that you get is not very big in reality. It gets eat up. So you need to enter with quite a substantial capital. And because you enter with a substantial capital, let's say that you got a token that have a movement to 40%. I'd rather have instead of one ETH of that token and one ETH to put both into a liquidity pool to get a 0.5% return in a day, I'd rather have both of them in the token and then get the jump of 30-40%. It's a higher return and a little bit less complicated to manage and keeping under control. But I know tons of people that are doing the exact opposite because they don't want to enter on a specific trade. They just want to they have all of these ETH that they accumulate in the past. They're just sitting there. So for them, it's just they buy new tokens and they already have the ETH to support that. So it's not a new trade.
Right.
Yeah, for me, I'm providing liquidity on a couple of small projects just because it helps the project. I know the project is fundamentally sound and they're not on really good exchanges, but I know that there would be more people trading them if there was some liquidity. So I've provided, equal values of this one token plus the equal value of ETH. And I just think of it as a really long-term savings account. So I'm willing to ride it up and I'm willing to ride it down. I just put it in and pool it, let it go for a while. I mean, that's one of the fundamental strengths of a DEX, right? It's good for the community. And these projects, they can have a liquidity pool without being extorted by an exchange, for a listing fee, right? So if a company is going to pay 5 Bitcoin to get listed, they can just take that 5 Bitcoin, wrap it, put it on the liquidity pool, and then provide their tokens, and they're going to get liquidity fees, right? So it's a tool also for projects. They can provide their own liquidity to a project, instead of going to an exchange. And it also works quite well for whales, like guys, you know, they have a bunch of ETH they bought a long time ago. They bought a bunch of ICO tokens and they want to see the project do well, so they'll provide liquidity.
Okay.
So there's a little bit of altruism in it as well.
Okay.
And if you're patient, you know, a lot of those impermanent losses that work out later. And
sure. So, I mean, obviously, fees aside here, I think what I'm going to have to do to go through a bit of a learning process is obviously dip a toe in and start playing around with this. There's no better way to learn. I think you alluded to that in our first show, Stefano, on this topic. Take a small amount, play around, get used to it. We hope we've explained high level what the DeFi space is, how to use MetaMask, how to use Uniswap. We're obviously got a little more complex in this chat. Next week we're actually going to be having some founders on, so there's quite a bit of a learning curve for me to really get up to speed on before we start talking to founders of some of these projects. Thank God you guys are joining me on those shows. Now, Jordan, before we go today, you have been harassing me for a very long time, and I probably should have listened to you just from a price point of view to buy some Chainlink. I actually met some key players in that project in Korea last year, and the price was, I believe, a fraction of what it is now. So, Stefano, Jordan's told me he's going to match my purchase in Chainlink, so we thought I'd get that on a recorded video so that holds up in a court of law. Number one,
I said if you buy 10 Chainlink,
through the,
I will send you 10 Chainlink. That's what I said.
Sorry, how many?
I said if you buy 10, I'll send you 10, no problem. And the current price is about $7.77. All right, just because we're buds,
give me $75. I'll take it. All right,
and I don't want you to miss out, man. I don't want you to miss out. You know,
can I buy Chainlink on my with a MetaMask wallet, or
yes, you can. Yeah, there's a huge liquidity pool.
Okay,
for sure.
Now, so very, 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 you know, in a nutshell, for newbies, Jordan, you've tried to tell me that Chainlink is a superstar that everyone needs to know about. It's crucial to the DeFi space. Can you give us a very short and sweet reason why you say that?
Well, I mean, all the pricing that you see on Uniswap, that comes from a Chainlink Oracle. They take the data from all the different exchanges, you know, Binance, Huobi, OKX, whatever, and they take that and they average the price. And using the Chainlink node, they verify the price, and then that price is fed into Uniswap, and that's how you get your average price on the swap. You're not paying with an order book, right? You're paying with the average global price.
Right.
So in crypto, if you look at the list of partners, like almost every DeFi project is either using Chainlink as an oracle, because it's the same as, you know, Bitcoin. It's first in the door, the network effect, it's decentralized. There's a lot of the same reason that Bitcoin is so big is that it's first in the door and it's the standard pretty much right now. There's a couple of other projects like Band, Trello.
I think it kind of warrants a show on itself, doesn't it?
Yeah,
to
for
really,
sure.
Is it crucial to understand what Chainlink does to really understand the DeFi space, or am I off the mark there?
Well, most of DeFi is powered by Chainlink, I think. You know, a lot of this, like the lending, the borrowing, the market. Anytime you're dealing with,
I know you're a massive fanboy, so Stefano, how would you answer that?
So it's super important, because like what an oracle does is basically like providing you the equivalent currency value of a specific token. So you can have that like in USD or other currency, and that's like extremely important for the user, one, because obviously like it's easier to understand like if your investments are going up or down and things like that. Yep. But two, is also very important for the people that are like developing, because you might have like options. Like we use oracles, for example, in our company, because the companies like cannot have their accounting denominated in BTC, for example, or in ETH. They need to be converted either in euro or in USD. Mm-hmm. So for us, oracles are super important in our business model on a daily basis. That it's very important what they're doing. It's absolutely like essential to bring the blockchain world closer to the normal world. So in terms of like usability and usefulness, 100%, Chainlink is super important.
Okay, so I was just reading some of the notes before that you guys were swapping with each other. There was a mini argument going on about the price of Chainlink and whether it would be a good buy right now.
Oh yeah, that's like a completely different thing.
So I'm clearly buying some Chainlink tomorrow so I can get my free Chainlink from Johnny Gonzo.
You're gonna get your,
should I sell it immediately, Stefano? Is that what
your 350 entry, man? That's people kill for that.
I'm like, the thing is that like, see, here's the difference on that. Like, if you're entering a 350, I agree with you, but
it's
right now
something now, isn't it?
It's 7.7. Like it got like a 100% run almost or whatever, like in a matter of like 10-15 days.
Yeah, it was well below $2 when I met the guys in
doing
Korea.
that every 3 months almost, every 4 months. It's like, oh, it's topped out, it's not worth it, and then it goes up another 100% because they keep adding more and more partnerships, more and more businesses. Like there's Swift and Google and Oracle and the China BNS, which is the blockchain network. Whole cities in China are running Chainlink nodes for price data.
And it's fair, but all big things sooner or later start slowing down.
Sure, no doubt. But I mean, we're just talking magnitudes of scale here, I think, Okay. Like the market caps of crypto right now is tiny. Do we agree? Like compared to the real financial world?
Oh yeah, for sure.
Right?
For sure.
And Chainlink is moving into the real financial world, the market caps, I think.
Okay, look, I'm actually super excited. Obviously having just covered Bitcoin for a number of years now, this is really fascinating to learn from you guys about what is happening in this DeFi space. I know you're both extremely knowledgeable, so I really appreciate you teaching myself and the audience. And look, make sure you subscribe to the channel, people. We've got some interesting founders of projects coming up. Really looking forward to that. And in tomorrow's show, I'm actually interviewing the inventor of the ICO. Looking forward to that. Yeah, that's in our Hard Fork series, which is co-hosted by Lawrence Grinseri of Skyhook Capital, a guy who's building has got the years of experience in fintech and wealth management platforms. It's fascinating to see what they're doing in the crypto space now. Merging those two worlds is really what we're talking about here with Chainlink. So exciting times, putting it mildly. I still feel I've got quite a bit to learn from you boys on how DeFi works. So look forward to talking to you both again in the next few days. So look, I'll leave you to it. Thanks for your time. Well, there's a donation address below to buy Johnny Gonzo some clothes. He obviously made some bad trades.
I only wear clothes on the bottom half. Come on, live in Thailand.
Otherwise, you will be arrested if it's not like in the bottom half.
Hey, can I just put out a little warning? As like we were talking about ICOs, right? The initial idea of an ICO was great, but then it got overrun with scammers, right? The same thing is happening on Uniswap. There is a real potential to get burnt hard there, because it's decentralized and there's no central party controlling the listings. If you just go and buy random shit, there's a real potential that the liquidity gets pulled and your tokens go to zero. Same as what happened with ICOs. So, you always have to do your own research, follow the tokens, check the communities, check on Twitter what's happening, follow as many videos that we're making as possible, right? All that kind of stuff. Yeah. You got to do your own research.
True. And I think we should definitely, I think we should absolutely go into a bit more detail on exactly what you've just said there, the best ways that you maybe can sort of safeguard yourself, because there are, some of the numbers getting thrown around at the moment are insane. I don't doubt for a second, and our last video was specifically made because the amount of people that are contacting me now asking about the space and how to get involved, having to talk people individually through setting up these wallets and what Uniswap is, etc. Go and check that video out if you haven't seen it. It's in the playlist. But yeah, look, we'll certainly talk more on that topic, Jordan. That was pretty timely to be a bit of a reminder there. Sometimes when it's a little too good to be true.
Yeah, FOMO is a mofo.
Yeah.
Keep that in mind too.
True. All right, there's lots of interesting people wandering around in your background there, Jordan, so I'll let you go and entertain them. And Stefano, you know, whip up nice pasta dish in your kitchen there this evening for your lady? Or?
No, we're going to make like a shrimp taco.
Shrimp taco, very good.
All right.
Okay.
Bueno,
all right, guys.
Bueno.
Excellent. Thanks so much for your time, and we'll see you all back here very soon. Make sure you subscribe to the channel, be in the draw to win the Bitcoin sock.
I can
actually no, we've got some really good stuff coming up. We do have a prepaid crypto card. We'll be talking to you about that in the next few days. A preloaded card. You've only got to be a subscriber to be in the mix. And we're also, as you know, finally getting around to tokenizing what we're doing here. So we'll show you how you can all get involved. That's coming up very soon. See you next time, guys, and thank you for watching, everybody.
Cheers, boys.
See
you
Bye
later.
now.